Good morning, ladies and gentlemen, and welcome to the MITON UK MICROCAP Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so. Before we begin, as usual, we would just like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to Head of Investment Trusts, Claire Long. Claire, good morning.
Good morning, Jake. Good morning, everybody. Thank you for joining us today for the inaugural presentation on the MITON UK MicroCap Trust on Investor Meet Company. Thank you very much for joining us. So with me is Gervase Williams, one of the two managers of the trust, together with Martin Turner. Gervase will be talking in some detail about the trust, providing an introduction, but just to say that the trust is a portfolio of smaller UK quoted companies, what are known as microcaps, which typically have market capitalizations of less than £150 million. It has a primary objective to generate capital growth over the longer term, and the trust is currently standing on a discount of around about 7%. So without further ado, I will hand over to Gervase to take you through the presentation.
Thanks very much, Claire. And if you remember the start of this presentation, the presentation is entitled Why We Are Anticipating and Getting Ready for a UK Microcap Super Cycle. So as a starting point, microcaps, UK quoted companies have been somewhat out of fashion. And what we think is the pattern's going to change. And the pattern over the last, 30 years, and this is just showing Tesla, it could be any company, really shows that actually not just that markets have been buoyant, not just that asset valuations have risen, bonds, equities, all in property, all sorts of assets have risen, but particularly companies which have been growing fast have seen a sort of enhancement of their share price returns by starting off at quite low prices. And as you know, Tesla came to market at $17, quite a low price. And at some points, in 2020, it was actually issuing new shares at $787. And the net effect is that if you bought it at $17, whenever you're issuing shares at $700, of course, the impact is that you have the new shares are buying a smaller part of the company than when you bought the original shares at $17. So you get this onward enhancement. And with the tailwinds and with the rapid growth of companies, it's really meant that many of these technology stocks, not just technology stocks, rapid growth stocks have done incredibly well. And there's been a real tailwind to markets, which has been brilliant. But most particularly, the nature of the transaction, these strategies is they need to be transaction-based. What do I mean by that? To get companies like Tesla correct and make good money on them, you have to buy them low and sell them high. You have to get the timing of two transactions right. And that's a feature which we think is going to get more and more uncertain as the market tailwinds die away, as inflation becomes more endemic, as we find that with nationalistic politics, we get to a period where we're getting more grumpy with our neighbours and there's more geopolitical events. The bottom line is we see that this pattern of return is going to run out. And just to kind of set this in context of how much this has driven valuations, this is looking at the S&P 500 index relative to the FTSE All-Share Index. And what you can see here is there have been periods when actually the S&P index has been very highly rated relative to the UK index. Going back to the early 70s, for example, we had the Nifty 50 at that stage. It was a bit like the technology buzz we've got at the moment. And unfortunately, inflation became more endemic. We had problems with the Middle East and energy supply. Doesn't it all sound a bit familiar? And what happened was the UK massively outperformed, the US massively underperformed. And we saw a bit of reversal of that with the dot-com bubble back in the early 2000s. What we've really seen is the valuation of US equities has been driven up, and most people have got involved in index funds. And so you've got to a stage really where actually the momentum of buying, especially in the mega caps in the US, has been quite exceptional. And so the danger is, as that pattern starts to unwind, just like we saw in the 70s, you can see that the setback can be very significant and very rapid. If you're trying to do a transaction-based strategy, it's lovely buying in a momentum and getting everyone buying together, but it means when you peak out, everyone sells together, and you get correlated selling, and valuations can do something awful, as they did in the 70s. So I'm not saying that's going to happen, but just so you know, that's the risk out there. So the nature of what we try and do is actually to invest in quoted companies. These are called microcaps, but of course, in real terms, these are companies generating millions of pounds of profit. In many cases, they've got maybe hundreds or thousands of employees. Many of these companies have global presence in a narrow industry sector. And they're only microcaps in that, things like Tesla and many of the mega caps are just giant companies. And so they are still very viable companies, very well-developed companies, but most particularly, they've still got opportunity to be immature. And when you go back over the years, and this is the data since 1955 in the UK, you can see in the sort of the greenish lines that the mainstream companies do make money, and this is true in the US market too. But actually, as you move down the size bands into less mature companies, companies which are more overlooked, then you can actually make more returns. And specifically, that dark blue line at the top is the microcap sector. So this fund fishes in the universe which has the greatest tailwinds. Now, there have been tailwinds over the last 10 and 20 years, but to be honest, everything's outperformed the FTSE up 100 in the last 20 years. In US equities, bonds, private equity, houses, and the rest of it. So people got pretty bored with this, but we expect this pattern to continue, but for the UK to actually have a period of outperformance. And what's interesting about the strategy isn't just that we've got some companies which succeed, but just occasionally some of the companies, when they succeed, because they literally fall to valuations which are overlooked by most of the professional investors. Most professional investors, are willing to look at mainstream companies, mid-sized companies, some top end of the small cap index, but they often put an artificial link in it where they say, well, we want a holding of 40 quoted companies in our portfolios. Even the small cap funds would often invest in sort of companies which are 2, 3, 4, 500 million as a minimum size. So when you get down to 150 million, most professional investors, there are some, but most professional investors stop looking. And when you get down to companies which are only, say, 10 or 20 million market cap, as U Group was back in 2000, then effectively there's actually very few professional investors willing to do the work. And you can get companies which are literally too cheap for people to buy. And that's a wonderful thing. If they succeed, and not all of them do, but if they do, they don't just appreciate, but they can appreciate very, very rapidly. And the great advantage of U Group isn't so much that it's gone up. It's been a holding in the portfolio over the last 4 years, but specifically, it's gone up faster than Nvidia. And people say, well, that's lovely, but we've missed it. Not always. I mean, in our case, we think U Group is still undervalued. It's gone up faster than Nvidia, and it's still undervalued even now. So if you look at the market cap, its market cap, I was just checking this morning, so it's just coming up to 290 million market cap at the moment. We bought it when it was about 14. They haven't issued many shares. But specifically on PE ratios, which is just a measure, according to the Bloomberg forecasts for the coming year to December and then the following year, 9.4 times and 8.5 times. Now, you might say, well, kind of okay. But it also has 99 million of cash in the balance sheet, right? On top of it, and no debt. And if it hits the forecast, and clearly, that's always uncertain, but if it does, then for December 25, it have 123 million cash. And indeed, in December 26, according to the forecast, 144 million. So the nature of it is, this company was standing on a valuation of 14 million when we first started investing. It's just extraordinary how overlooked companies can be and how successful they can be. And when they are successful, of course, when they get to 300 million, quite a lot of the mainstream professional investors start to think, well, you know what? Actually, this is an interesting company. Let's just have a look. So it actually gets easier to sell as they get bigger. Amazing. And we've got a lot of this to happen. I mean, what's been interesting about the last 30 years is that actually, globalization has been the main dominant theme. Higher beta companies, these are companies with more volatility, they're growing, high growth companies have outperformed. A lot of the UK companies are what's called low beta. What I mean by that is they generate surplus cash, they're slower moving, they generate a large part of their return by compounding the income. But most particularly, that's meant that actually nearly all investors have taken profits in the UK and put the capital into the US. And as you see, the value of the US market's gone up a long way versus the UK. And what's been most interesting about that is we've actually seen that actually happen within the UK investor universe as well. So you can see that big light blue area, which is actually all those insurance companies and pension funds, and they've all gone as well. And so we've got to a stage now where actually the UK quoted companies that they're undervalued, cost of capital is higher, They're not able to generate local employment in the way that they would normally be able to do. They can't generate the productivity they would normally be driving. And some of them, because they don't invest, don't generate the cash and thereby the tax take for the government. So the government, and this is both parties, are very, very keen that UK capital comes back to UK quoted companies, and in doing so, actually boosts their returns, boosts their valuations, allows them to raise capital. And you can see that the scope for the reversal of that light blue line in particular is very substantial. And the government is right now doing a review with Emma Reynolds of the pension sector, and the outcome will be, one way or another, that will there be more capital in the UK. And that's great for the mainstream UK companies. They're buying back their shares. Their valuations have come down, but not as badly as the microcaps were over the last 3 years, with the local selling, and particularly with OIC redemptions, have fallen, have massively underperformed the A markets, very heavily underperformed the mainstream market. And so there's large numbers of quoted companies out there which we think are standing on valuations which are literally too cheap for people to buy. And when that reverses, it won't be all like U Group, but there will be opportunities to deliver return. So when you look at the portfolio, and you can see that sort of orangey bit is really the kind of companies which are often of a market cap, and this about between 50 and 150. So that's a core part of the portfolio. That blue color, that sort of mid blue color, is the companies between 0 and 50 million. The portfolio is very wide ranging. And investors say, well, actually, why would you have 120 holdings? Why can't you pick your best 50 or best 30 or whatever? And of course, the truth is, if we had a portfolio of, say, 100 million, it's less than that now, but say 100 million, and we wanted to put it into 30 holdings, each holding would be 3.5 million each. And if we had a company like U Group at 14 million when we wanted to buy it, we wouldn't be wanting to buy 20%. We might not be able to buy 20%, right? And so it would have been excluded from consideration. Well, we don't want to do that. You know, companies which are too cheap to buy, we want them in too. And so if we could only get 1%, which is what we got into U Group, and if it does go up, 20 times or what it was done, every 20 times is worth having, even at 1%. So the nature of it is actually that we're very keen to have this wide-ranging portfolio. It does mean when we get them wrong, and don't get me wrong, we do get them wrong too, but specifically it means that when the share prices drop, these are relatively small holdings, there's usually a kind of plume of activity, albeit at the low share price, and if we believe we're wrong, we need to get the capital out, we can withdraw capital and put it into companies which are succeeding. So the portfolio is quite dynamic. And as you can see, there are some companies which are bigger than 150 million. These are companies which have already risen to some extent, like U Group, and some companies which in the past have even risen to 1 billion. That's not because we bought a 500 million pound company which doubled. It's because we had a company which was less than 150 million, which went up to 1 billion. That's the nature of the opportunity sometimes. And so the nature of the fund is that it's extremely well diversified. There's all sorts of different holdings, different sectors, some less mature, some more mature, some local companies, some international companies, some with novel business practices, some which are in older industries. But the nature of it is, therefore, you've got this wide range of holdings. And people say, well, is it ever going to make money? And of course, the answer is yes. I mean, it's not just because, companies, when they go up, can go up 10 or 20 times. Sometimes they're not all of them. But actually, of course, you do get patterns when actually a lot more people are looking at the microcap sector, and you get a run. From March 2020, for example, when we had the global recession on and global companies weren't growing very well, this was a period when actually the UK market not just outperformed, but most particularly small microcaps outperformed, and this is a microcap fund. And in fact, UK microcaps were one of the best performing assets in the world, actually, over the period from March 2020 through to July 2021. So that's just a glimpse of the opportunities we see it. Clearly, we're right down at the bottom now. It could get marginally lower, but there are opportunities now to see it beginning to unwind. And when it comes right, it can come right in quite exciting returns. So when you look at the sectors, what you do see is, yes, you have got the mainstream sectors. So we do have some information technology, don't get me wrong. Many of these companies are companies which have done well in the past, but perhaps come down. Some of them are lesser companies which have never really grown very large, but they are in themselves, many of the microcaps aren't reliant on the global growth to deliver their return. They're in a specialist sector. They've got an opportunity in that sector to do extremely well, and we've got some examples coming up. But unusually, and in contrast to quite a few other small cap investment trusts, we're very open-minded about investing across the full range of sectors. If inflation becomes more persistent as a problem going forward, and in a way I hope it does, because I don't want deflation, which is the alternative, then you will find that things like bonds won't do very well. And so diversification via equities and bonds, or shares and bonds, won't work as well as you might expect, in which case you need to buy physical assets. Minerals and mining companies are companies which are often digging out new materials for the global, and so including gold, of course, hitting new highs at the moment. So the fund does have quite a lot of mining companies, and don't get me wrong, they can generate some very good cash flow as a result of that, and we're quite excited about that. Complicated financials, even the mainstream stock market, when it comes to complicated financials, when you look at certain parts of the insurance sector, perhaps life insurance companies, you can buy mainstream FTSE companies on yields of 8, 9, even 10% in some of the financial sectors. As you move down the range, of course, people say, well, if I can buy one of the mainstream companies on that kind of yield, why would I bother at small cap? So some of the micro-cap financials are absurdly incorrectly priced in our view, and have that opportunity to outperform. And then we've got industrials. And again, the great advantage of companies which have physical assets is that many of them have factories. And if the cost of capital goes up, if inflation becomes more persistent, and interest rates, whilst they're coming down now, doesn't come down as far as you expect, or indeed goes back up again, then companies with factories already built will find that actually there's very little competition coming up, because actually the cost of building a new factory is so much more expensive, and the cost of financing a new factory is so much more expensive. And so you can get these capital intensive businesses which get option-like upside, a bit like U Group. And then that goes into other kind of areas. You can see energy sector there. Now, just to make it quite clear, we are very interested in the climate change agenda. We absolutely think we need to do things about that. But if you eliminated all crude oil, say in 2050, you wouldn't have any plastics. And we just think it's ridiculous to think that hospitals are all going to close down, and the food industry and the travel industry is going to work. We think, so don't get me wrong, we need to actually think about energy, and we need to kind of change the energy mix going forward, but we still need crude oil even in 2050. And what we really want is companies which are carbon intensive, very careful to reduce carbon intensity, so that they can actually worry about the world and obviously deliver the plastics for the future. So how do we pick the stocks? The main thing is that we look for companies which we are called immature income stocks. So these are companies which may have been investing for some years, conclude a period of investment, and as that investment comes through, as the capex required going forward reduces, then you do find that the opportunity for them not to succeed but generate a disproportionate cash, like we saw with U Group, doesn't just bring them through, but then allows them a range of options. If you've got disproportionate cash, you can invest in your business, you can start paying dividends, you can make acquisitions, you can buy back shares. Don't really like buying back shares, but people can do that, etc. So coming back to it, we need companies which have rising turnover. That's where the cash comes in at the top. So rising turnover is a big part of our process. Unexpected cost increases get passed on to customers. What we really mean is profit margins are sustainable. Profit margins are near record levels around the world at the moment. I think working assumption is if we do get this kind of deglobalization period, this protectionism period, we think the profit margins will probably halve over 20 years or whatever it is, even 10. We don't know. So how do we hold on to valuations? How can we invest in companies which generate surplus cash and don't get profit margin squeezed? Of course, some of them will, but the main thing is we look for companies which are delivering outstanding service. Yes, competition can come and ask you for your customers, and they can offer low prices, but if you're delivering not good but outstanding service, how many presentations do you see by companies talking about outstanding service? Not many. It's a really good way of adding value. And then you want, of course, the staff at the front line, I'm not talking about the management team, to feel really engaged so they can deliver outstanding service. These are the things we talk about when we meet companies. And then we move on to management teams. There are some management teams who are a bit overconfident, and you may find this with fund management teams. If they're overconfident, you can sometimes lose that badly because they're just overconfident. And so we like people really feet on the ground type management teams. We like safety. Not all the companies have net cash balances, but we certainly want them to have plenty of financial headroom in their balance sheets. In other words, if they do need to borrow, and they can borrow in a hurry. So safe companies in terms of that. So if there is a disappointment and we do get things wrong, it's not an emergency rights issue. And then we're just very mean. Martin and I are very mean about valuations. We won't pay up for valuations. We want things. So these are the green lights. These are what we look for. Clearly, we have sell disciplines, and they're just the same. In other words, red lights. So falling turnover, margin compression, management team becoming overconfident, perhaps an overgeared balance sheet, and ultimately evaluation which has gone too high. So that's the nature of it. We call it the traffic light process. being entirely brutal, of course, like the real world is often talking about an orange going green or an orange going red. And so there's a lot of judgment involved in it. It's not just quite colour by numbers. So these are some of the examples of the holdings in the portfolio. Some of them are companies like Zoo Digital, where actually the industry has suffered a major setback. Those people who know Zoo Digital, it's one of the world leaders, possibly the world leader in dubbing and subtitles. Share price was £2 previously. It's down about 40p at the moment. They haven't raised extra capital. So with the Hollywood strike, of course, volumes have come down. They're now getting renewed interest from Disney and possibly Netflix in due course. So that's the kind of nature. Will it go back to £2? I hope so. I think it's got a good potential. I think it could go to more than £2. But anyway, time will tell. We can buy into recovery. Perhaps Concurrent is a different example, where you actually had a family management team who'd been in charge of this company for many, many years. And actually, the company was very poorly run, really. And then a new management team came in about 2.5 years ago, and we are very upbeat about the quality of the management team. And so what's interesting about Concurrent is it's only 100 million market cap, but it's a defence company. It's on single board computers. What tends to happen is when you want to upgrade your tank, you don't just put a new gun on, perhaps you do or don't, but most particularly what you do is you take the computer cards out, put in new computer cards. It's as simple as that. And that's what Concurrent do. And I think they're one of the leaders. So effectively, if you go back in the past, when the new management team arrived, it was only about 30 million, even if they won every order. They are now in for orders which are many multiples of that. And so, sales have already doubled since the new management team came in from 18 to 36. But most particularly, we think they can double or triple in due course from here. Syncanode, of course, is a company which is, again, share prices look pretty disappointing, but actually it spent the last 10 years developing the smart metering market in India. It's one of the leading companies in the sector. It's doing very well. President Modi is rolling them out. They've got tenders out for 1.1 billion. They're not going to win 1.1 billion, but they've got about 25 or 30% of the Indian market at the moment with all the utilities. Are they going to get 25 or 30%? Maybe they will, maybe they won't. It doesn't matter. Even if they get 10 or 15%, the share price could go up. And it's only 31 million market cap at the moment. And net cash, again, like we saw with Zoo Group, Zoo Digital and Current. And then Beeks, of course, has started to move. So Beeks is Exchange Cloud. So, it's got a number of different products which come to market over the years. But the Exchange Cloud looks like a really knockout product. They installed it for Johannesburg Stock Exchange. And basically, it's just a pricing engine with lots of servers around it for all the different operators. And you get very, very efficient transactions. Already, actually, Johannesburg has already had to increase, capacity twice dramatically. The reason why the share price is going up is because they've got a contract with the biggest exchange group in the world. Now, they won't say who it is, but if you go on the computers and check, the biggest exchange company in the world is NASDAQ. So it looks as though they're working with NASDAQ, and that could drive. Anyway, these are just examples. The bottom line is there's just a great plethora of global leading companies, often at valuations which are very overlooked, and the risk-reward ratio, in our view, is incredibly attractive. So yes, I mean, when you look at the returns, actually the fund's done not much. It's a relatively poor performer relative to most of the other UK small cap investment trusts at the moment. Mid caps have done better, small caps have done worse. Micro caps have been largely missed out. Some have gone up, but most haven't. So actually the returns over the last 2 or 3 years look pretty poor. But actually, there have been periods where we've just seen that glimpse of recovery. And when we saw that period between March 2020 and say July 2021, what was interesting about this fund is that actually, clearly with the pandemic, the share price came down, the NAV came down. I think it got down to about 37.28 on the 17th of March. But most particularly, within less than 18 months, it had reached 107. Now, is that going to happen again? I don't know. But that's the nature of the potential. And more importantly, I think the duration of that recovery is not going to be just sort of 15 months. We're talking about 5 years, 10 years. My own view is that there's a super cycle coming, with UK quoted companies being some of the best performers in the world and the best performing part of one of the best performing stock markets in the world being microcaps. That's the nature of the opportunity. That's why we set the fund up. That's where we're going, hopefully. And so when you look at the portfolio, yes, Zoo Group, we've taken substantial profits already. As I say, it started off at 1%. It's up over 20 times, so we've taken substantial profits. Why haven't we sold it all? Well, actually, one, because we still think it's cheap. Secondly, because we haven't got many other utilities. It's a utility, a bit like it's taking market share from people like Aeon and Centrica. And so we can take profits, but more importantly, it's already, we think, on its way, and it's becoming easier to sell as we sell it, get larger. But then you can see MTI Wireless, which is a company which is involved in aerials. It's 5G aerials. It does a certain amount of aerials on companies which actually do irrigation. So again, net cash, generating a good and growing profit, pays good dividends in that case. And then you can see Zoo Digital, Concurrent, all of these companies. TrueFin had results yesterday. The bottom line is we believe we've got a really nice mix of companies out there. So the bottom line really is, why do we think there's a super cycle coming? And we just think that actually, during the globalization period, we've been driven by these transaction-related strategies, which are often capital gain in orientation. And we just think that pattern is coming to an end, as we saw in the 70s. We think the UK, a lot of people think the UK is actually fairly boring, full of companies which don't grow properly. But actually, the great advantage about the UK stock market as a whole is that many of these companies produce income. And if we've got this cash squeeze coming on, and there's going to cash running out because governments aren't struggling borrowing, and they're taking all the cash, and perhaps the cost of interest rates gone up, and some companies going bust. I think most of the zombie companies go bust, for example. Then of course companies which actually generate cash have the advantage that they don't go bust. Good start. But much more important than that, if you've got a company which has gone bust and you are a company generating cash, you can move into that vacated market almost free of charge and take market share. And on top of that, of course, there will be opportunities to buy companies which are perfectly viable businesses, but were overborrowed. And the borrowing meant they go into receivership. You can buy them from the receiver, a bit like we saw with HSBC and SVB UK. They paid £1. Wonderful. That added £1 billion to the valuation of HSBC or whatever. And that's great when you're 50 or 60 billion. Clearly, if you could buy a company from the receiver for £1, albeit you have to put working capital in 20 or 30 million or whatever, but most particularly, if you can get a cash payback on that 20 or 30 million within, say, 18 months, then obviously, if you start off as a company of 50 million market cap, you raise 20 million, you generate extra 20 million, and you transform your prospects. That's why we're excited. So we think the UK is going to start a period of super cycle. We saw recently with Bank of America data yesterday, fund manager survey, for the first time for 3 years, people are investing in the UK. We've seen the FTSE 100 in terms of its breaking out of its long-term trading range since 1999. And that's at a time when local sellers are still voluminous, and that's related to buybacks. And as those local sellers dry up, we think the UK will outperform more. And we see this catch-up trade in microcaps. Get ready, in our view, for UK microcap super cycle. The other feature I should just mention is, I think going forward, we just don't know what the future brings. Let's not be too certain about it. But really, we've had abnormally strong returns during globalization, and I think we'll have a depressingly poor returns in this period of kind of friction coming up. And specifically, I think that many mainstream markets won't go up at all. I mean, the nature of stock markets can flatline for many years. And if that is the case, then there's only going to be little areas of specialist opportunity to generate return. And we think microcaps, UK microcaps, are going to be one of those. And if you do invest in a unitized vehicle, an OIC or whatever, the nightmare is that they get too much money. People say, oh, this is marvelous, it's generating lots of alpha, let's get involved. And they get more money, and then they can't invest in microcaps because they get too big. The huge advantage of investment trusts is they can say, actually, 20, 200 or 300 million, whatever the board chooses, we can just say, actually, we don't want to get any bigger, because we need to deliver that alpha, and we can only do it in small size. And so my view is that investment trusts will become vehicles of choice for institutional investors going forward over OICs in specialist areas like this. So to conclude, I think the world are going through a period of change. I think we've been through this extraordinary period of capital appreciation, and that's led to zombie companies, not even zombie companies going bust. We think there's going to be a change. Specifically, unfortunately, we think inflation will either be too high or too low going forward, not just right as we've been. That kind of Goldilocks period is going to go, and we're going to get these kind of very big fluctuations. And generally, this will put not just zombie companies into insolvency, but many of the other companies which are overborrowed. Quoted companies have stronger balance sheets, so they're safer. But more importantly, as they mature and become cash generative, we think the opportunities open to them. This immature companies coming into income providing stocks like U Group, we think will be advantages. And then on top of that, if things get really tough, I think they will, unfortunately, then obviously you can actually move into the vacated markets. You can move into buying companies from the receiver, over leveraged but viable businesses. And we think that actually, as you find this pattern starts coming through, we find many of our small cap competitors will start to move down the range. Yes, they'll have some mid caps. Yes, they'll have some small caps, but they'll start to put half holdings or quarter holdings into the equivalent of you group, because that's the only way they'll keep up with us. So from that point of view, we think that actually the pattern is going to change. Tiny amounts of money make all the difference. These are micro caps after all, relative to mega caps. So actually, even the slightest change is going to be substantial. Thank you very much.
Thank you, Gervais. Jake.
Perfect. Claire, Gervais, if I may just jump back in there, and thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the top right-hand corner of your screen. But just while the company take a few moments to review those questions that were submitted already, I would just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can all be accessed via your investor dashboard. Claire, Gervais, as you can see there, we have received a number of questions throughout your presentation this morning, and thank you to all of those on the call for taking the time to submit their questions. But guys, at this point, if I may just hand back to you just to read out those questions where it's appropriate to do so and give your responses. And if I pick up from you at the end, that would be great.
Great, thank you, Jake. Okay, Gervais, we've got a question here about Mini's annual voluntary redemption facility. Has it made it more difficult to manage the trust?
Well, the purpose of the voluntary redemption facility is it's not our capital, it's yours. Right? So if you need your capital, then we want to make it as easy as possible for you to exit, albeit that we don't want to actually hold back the returns of the long-term shareholders, people who want to stay in it. So the purpose of the redemption mechanism is that if it's small, and we've had some times when it's just 1 or 2%, fine, we've got some cash that can be paid off at NAV. But if it is a significant amount, and last year I think it was about 18% or something like that, but if it was anyway, what we did is we put all of the holdings, 18% of all the holdings, into a liquidation pool. It took a few weeks, we liquidated, and we send you 100% of the cash back. And the reason we do it that way is, one, you get a return something close to the NAV. It's not always the same. There are costs. Sometimes things go up and down, but most particularly you get something in return. Importantly, you get a good exit. But also the core shareholders don't mind. So we had a big redemption around the time of the pandemic. As you can imagine, 2020, people wanted their money back, and some people had their capital back, and that was fine. There was a redemption. But the remaining shareholders, no disadvantage for them. They remained fully invested. The portfolio, brought in some new holdings. We took some profits on others. But as I mentioned, the NAV went completely ballistic, even at the time of redemption, right? So the whole point about redemption is it doesn't interfere with the returns of the core business. And most particularly, if people have a good exit, well, perhaps they'll come back in the future. And so the nature of it is, we just want people to have a really good experience with this. That's why it's there. Of course, the fund gets smaller, and that worries people. But of course, the main thing is just to remain alive at the bottom, because the fund could be multiples of its current size in the next couple of years if things pick up as we expect.
And I think that probably links into another question. Is the board considering the viability of the trust? I guess that's related to its current size.
Yeah, I mean, the viability is a sort of, it's a judgment, isn't it? The whole point is, why would we, as a fund management group, why would the board, and the board will have their own views on this, but why would you want to actually ask everyone to have their cash back at the bottom of the cycle, right? So I do understand it's small and the costs are higher, and we as fund managers actually get no fee if it gets too small, but that doesn't stop us managing it, by the way. We're happy to manage it even with no fee, because we see the potential. We want our clients to be fully invested at the bottom in microcaps if we're right about the future, and make what we might consider to be absurd amounts of money in the future.
We've then got a couple of sort of related questions about liquidity. The first being that liquidity in microcaps can be challenging. Market valuations can be wide of the underlying value, as we've seen in takeover premiums. How do you manage this?
Well, the first thing is we've got a long list. And that's not, as I say, because we can't make our mind up. It's because actually we like the idea of having relatively small holdings. That gives us option value. Sometimes they go up 30 and 70%, but sometimes they go up 15 times and all that kind of stuff. So first of all, we've got a range of holdings, different sectors, different maturities. And when an unexpected event happens, like in the Ukrainian war, for example, then, of course, some stocks get stuffed. But actually, some of our energy stocks went up a long way. So actually, diversification is very important to us, and that's why the fund has a long list of holdings. But of course, the side effect of that means is that we can have maximum liquidity, because we've got 120 or 130 different opportunities to take profits. 120 different times to actually invest in secondary transactions, in takeovers. We can get the cash from the takeover and put it back into company portfolios. When they succeed, like U Group, and become much bigger, we can take profits on a high valuation and put them in a lower valuation. So coming back to it, the whole point about having a long list isn't because we can't make our mind up, but actually because it maximizes liquidity. And maximizing liquidity actually enhances the returns for shareholders as we see it.
And then in terms of the liquidity risk, how do you approach liquidity risk when it comes to exiting positions in smaller, less liquid stocks?
Yes, I suppose the kind of the scenario we're looking at here isn't, U Group. It's very easy to exit, but coming back to a company which is disappointed. And usually there are moments when they announce the figures and everyone says, "Oh God, there's a big downgrade," or perhaps there's an announcement, a contract lost, or perhaps a director's left, or whatever. And normally, always, not every time, but normally there's quite a big share price movement for that. And the great advantage of that means that actually people who said, well, it was 10p yesterday and it's now 5p today. Some people say I want to sell, but other people say they want to buy. And so you get this kind of plume of liquidity. And this means that when we do get things wrong, we have to make our decisions quite quickly. Are we in or are we out? Now, don't get me wrong, it's not nice to sell at 5p when it was at 10p yesterday. But if we need the capital back and we have got it wrong, much better to have capital back now than have something which has become a liquid we can't sell in the future. So we take a decision straight away.
Yes.
And that means that we can move in and out of these things. And this fund is never going to be enormous. As I say, it's not going to be 1 billion or 2 billion or whatever. So from that point of view, each holding is relatively small. The market activity is quite high. We can make decisions on that straight away.
And related to that, what are the primary factors that would make you want to exit a position?
Well, as I touched on in those traffic light processes, the main things are if you find that turnover growth isn't coming through as expected or is being held up, then from that point of view, we actually are in a position where that red light comes on. It's just not growing the way it was, and we've got other things. So sales growth. Secondly, profit margins. It's all very well having sales growth, but if you've got profit margins going down, you're not generating that cash payback. So secondly, that's the second one. Thirdly, we meet management teams who's, after a while, PLC management teams, not so much microcaps, but some of the mainstream companies, when they've been poured at by all sorts of press and shareholders, and they people, you are rather wonderful. After a while, sometimes they begin to think, they start believing they are rather wonderful. Short-eyed to sell, absolutely. And then you get companies which have got debt and more debt than we expect, or take on more debt, or haven't got much headroom. That's another ring. And then of course, just occasionally the share price goes completely ballistic and the valuation's fine. Not another reason to sell. Those are our sales.
Okay. And then a final question: do you get actively involved with your portfolio to look to maximize value?
Yes, I mean the nature of it is, clearly a lot of shareholders, on the mainstream market engage with Sainsbury's and all the other mainstream management teams. And actually, I think some of the management teams are quite good. Actually, I think Sainsbury's is quite good. Actually, in a diverse income trust, we have some nice reason I engage with them on that. But the truth is, when I'm engaging with mainstream companies, our clients might have 0.01% of the company, and we might have 0.1%. And even, BlackRock can only have 3% or 5% or something. So basically, these management teams are the big companies. When you engage with them, to be honest, you haven't got much leverage, because you might say, well, I might get really grumpy, might sell our shares. And they say, well, if you sell 0.1, it's not going to change my life. The nature of small caps, microcaps particularly, is many of our clients have 3, 5, 7, 10%, right? And we engage with them. They haven't got many other institutional shareholders. And most particularly, if we do sell, they look at the opportunity of doing a deal is much more difficult without the few institutions which are in there. So we can have a huge influence. Now, we've got to be careful. We're not running the company. They know what they're doing more than we do, but we have strong views, and we do give them opportunities to think about agendas and all that kind of thing, to minimize risk, to generate return, to make sure that actually over time that they generate a better return. So absolutely, we do very much engage. And I think we have a lot of influence, but only so far. We don't run the companies. We make our views plain. And sometimes people agree and sometimes they don't.
Thank you. Jake.
Perfect. Claire, Gervais, thank you very much indeed for being so generous of your time then, addressing all of those questions that came in from investors this morning. And of course, we will publish all those responses on the platform for investors to access. But Gervais, perhaps before really just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that would be great.
Thank you for that. I mean, the first thing is, this is an investment trust. We're a service business. We too want to deliver outstanding service. So if we're not delivering outstanding service, let us know. We try quite hard in the annual report, in terms of engagement, in terms of on the website. But anyway, first of all, so if we're not doing well enough, or we've got better ideas, of course, we have to do that. The second feature is this fund hasn't done very well, and people think, well, perhaps it won't do very well, or perhaps they'll catch up a bit. No, the opportunity is for this fund to have an abnormal period of outperformance. Not just to keep up with the mainstream companies in the UK, not just to outperform some of the other UK small cap investment trusts, but to outperform it and to perform it on a persistent basis. We are preparing for a UK microcap super cycle. That sounds absurd, and until it comes through, people always find it hard to believe. This isn't about the UK economy. It's not about our politics. It's about the nature of difference. Most people have got most of their capital invested on red, and they've got no black. And basically, they just need to balance up. And then that even small amounts of capital coming back in drives it. We're already seeing that, as I say, Bank of America survey yesterday, the breakout of the FTSE 100. So we've already seen the start of this. We predicted it. It's happening. What we haven't seen yet is the draw through in small and microcap. And of course, because they've come from a lower level, you get that whiplash effect, that catch-up effect. And as the cost of capital rises, so as the share price rises and the cost of capital comes down, then companies can use their shares to acquire assets from a receiver, to do more deals, which are more enhancing, and actually not just survive, but thrive through what may be a very unsettled economic period, as they did in the 2020 period. I think it's not just an attractive risk-reward ratio, it's a real diversifier. Needless to say, I'm somewhat upbeat about the future.
Perfect. Gervase, that's great. And thank you once again for updating investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of the MITON UK MicroCap Trust PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good morning to you all.